This is not a debate about which one is best. I'm holding both in my portfolio. FXAIX for stability and FSPGX for growth. They are both low cost ways to grow your money by investing into Fidelity mutual funds. Today, I'm going to be talking about the Fidelity 500 Index Fund, FXAIX, as well as the Fidelity Large Cap Growth Index Fund, FSPGX, a new addition to my portfolio. And we'll also take a quick look at two ETFs similar to FSPGX, bringing growth to your portfolio. And those two are SCHG and VUG. So if you're new to investing, trying to catch this AI growth from these huge tech companies, this video is for you. If you're new here, make sure to subscribe, like, and hit that notification bell so you can keep up with all of my videos and live streams. So let's get into it. What is FSPGX? It's Fidelity's large cap growth index fund. It bets on big US companies growing fast. Think about those tech giants like Nvidia and Amazon. It tracks the Russell 1000 Growth Index. This index picks companies with strong earnings, rising sales, and high price to book ratios. So, what is a price to book ratio? It's basically of checking if a stock price matches its assets. Higher means investors can expect big future wins. And when it comes to this fund, it has a low expense ratio of just 0.035%. That would be $3.50 for every 10,000 invested. So this fund, FSPGX, is all about the Mag 7. Here's a look at the latest breakdown from August off of the Fidelity site. These top 10 companies make up about 60% of the funds. That's much more concentrated than many other funds. It gives us exposure to Nvidia, Microsoft, Apple, Amazon, Broadcom, Meta, Tesla, Google, both classes. And then when it comes to the sectors that you get exposure to, you're getting 50 to 55% technology. Think AI. About 15% consumer discretionary, like Amazon and Tesla. 11% communication services, Meta, Google. So, with the way things have been moving related to AI, this fund has been able to shine. But of course, you have to be mindful that when tech crashes, a fund like this is going to be hit hard. So, as I said, I'm adding this to my portfolio to give additional growth, but I'm getting my stability from FXAIX. It has an expense ratio of 0.015. It's a go-to for many when it comes to their retirement portfolios. It mirrors the 500 largest US companies and gives exposure to all sectors. But those top holdings are many of those same names we just looked at: Nvidia, Microsoft, Amazon, Meta. But when it comes to this fund, it only makes up about 38%. It's more diversified, with about 33% going into tech, 14 into financials, 10 into consumer discretionary, and 10 into communications. But we're also getting exposure to healthcare, industrials, consumer staples, energy. So when it comes to FXAIX, you'll have a smoother ride than with FSPGX. And when it comes to that 0.015% expense ratio, that's $1.50 for every 10,000 invested. So we're getting stability, diversification, and less drama when it comes to FXAIX. So let's take a look at how those two stack up against each other. Looking at a 5-year performance, we see that FSPGX has a slightly higher annualized return. So why the gap? It's because the tech industry has been an industry leader in the last few years. So when it comes to risk related to these two funds, FSPGX has a beta of 1.1, which means it swings more than the market, while FXAIX has a beta of 1.0, which means it matches the market. So basically, back to beta, it measures volatility. For example, looking back to 2022, when tech took a crash, we can see that the drops when it comes to FSPGX were more significant than FXAIX. It dropped by about 30%, while AIX was only down by about 19. But over the long run, you're getting a higher reward for higher risk. So, which fund is best for you? FSPGX is the way to go if you want maximum growth. Tech heavy, a way to ride the technology and AI boom. More ups and downs, like we saw with that 2022 crash. So, that one might be better suited for younger investors that have more time. Then we have FXAIX, a pick for steady, broad market gains, diversified across tech, healthcare, financials, all of the sectors. A smoother ride when it comes to those tough times like 2022. Pretty much, I think, a great choice for all investors, but especially those that want low risk. Now, as I said in the beginning, it's not a either or for me when it comes to these two. My strategy is I've already built up a strong foundation of FXAIX, and now I want to add in some FSPGX for that added growth. Think about the points that I've shared about these two funds and then match it up when it comes to your age, your risk tolerance, decide what's best for you. When it comes to my portfolio, I'm definitely trying to maximize what I already have in my retirement accounts, trying to build and grow and pretty much make up for those years when I was not as knowledgeable. Some gaps in time when I wasn't contributing as much because I was laid off looking for my next position. And because right now I am staying on top of checking on the performance of my portfolios, I definitely feel comfortable that I will make adjustments to my portfolio to dial back the aggressive choices that I'm mixing in right now. Another one that I am incorporating is ticker symbol SPMO, which is Invesco's S&P 500 Momentum ETF. I recently did a video on it, and I will make sure to tag it here and put it at the end. Here's a look at the 5-year performance of SPMO versus FSPGX and FXAIX. So you can clearly see the returns are significantly more than the S&P 500. But check out that video for more information on how that momentum ETF works. And if you prefer ETFs or you're with another brokerage company other than Fidelity, I just want to highlight a couple of ETFs that give a similar exposure, similar performance, and fees to FSPGX. And those funds are SCHG, the Schwab U.S. Large Cap Growth Fund, and VUG, Vanguard's Growth ETF. They track those same big companies as Fidelity's large cap funds, basically have the same expense ratio on this chart. It's just rounding FXPGX up a tad to 0.04%. So basically, $4 for every 10,000 invested. Their year-to-date returns are similar between 13 to 18%, and taking into consideration the Sharpe ratio, which is how much return you get per unit of risk. The higher equals better bang for your buck. They all have great risk-adjusted returns. So looking at these three funds together, we see they all move very similar and are very close when it comes to the performance. But when it comes to ETFs, exchange traded funds, they trade like a stock, and you have flexibility of investing into them on different brokerages. Whereas FXPGX is a mutual fund, which will have you limited to Fidelity. When it comes to FSPGX, I'm just getting started investing into it. I will come back to you with an update on how it's performing once I get my share size built up a bit. Definitely looking forward to the potential growth that I want this fund as well as SPMO to bring to my portfolio. Low fees, 0.035%, always a plus. And I'm anticipating the way AI has been driving growth, a fund like this will thrive. But I have my FXAIX to keep my portfolio steady. Here's a look at my retirement portfolio that has the largest amount of FXAIX in it. I'm currently up 44.06% when it comes to these 745 shares. And we'll be getting our dividends soon to build that up a little bit more. So remember, this is not financial advice. I'm just sharing my investing journey here. Do your own research, get advice if needed. As for me, I am ready to reap the rewards of these AI gains. Drop me some comments and let me know how you are striving to gain more growth when it comes to your retirement portfolios. What goals are you working on as we're coming to the end of 2025? If you haven't already, give this video a thumbs up, subscribe, hit that notification bell. Let me know if there's any other funds that you'd like to see me do a comparison of. You can support the channel by joining channel membership and using my referral links. They will be in the description and pinned in the comments. Thanks for watching. Okay, bye.